This content creator is 27 years old, worth just under $1.1 million, and plans to DCA into crypto. But is dollar cost averaging the smartest way to deploy his risky bet? Here's why lump sum investing might actually make more sense, and why DCA might secretly be holding him back. Over the next year and a half, he's planning to put $250,000 into a high-risk play like Bitcoin. But here's the thing, the way he's planning to do it is through dollar cost averaging, slowly buying in over time. That sounds safe, right? It feels comfortable, but is it actually the smartest way to deploy such a big bet? Or is it secretly holding him back from making the most of his money? In this video, we're going to break down his strategy, look at what dollar cost averaging really does, and compare it to the alternative, lump sum investing. By the end, you'll see which one actually makes more sense, and especially for someone in his position. So what exactly is dollar cost averaging? The idea is simple. Instead of putting all your money in at once, you spread it out over time. So for example, if you have $12,000 and you want to invest it into the stock market, instead of putting it all in today, you decide to split it into 12 parts and invest $1,000 each month for the next year. Here's why people like this strategy. If the market crashes right after you buy, no problem, you still have 11 more chances to buy at lower prices. This feels safer, and it definitely takes away some of the fear of bad timing. But here's the catch. It only works in your favor if the market falls while you're buying in. If the market rises during that 12-month period, which historically it does more often than not, then you end up paying more for each purchase compared to if you had just invested everything on day one. So dollar cost averaging reduces the sting of a sudden drop, but it comes at the cost of potentially missing out on some gains while your money sits on the sidelines. Now, even if his approach matches his personality, he does admit that he's naturally conservative. Does dollar cost averaging actually help him here, or is it slowing him down while the market runs away? Now, whether he's spreading these buy orders over time or going all in with a single purchase, he does have a solid strategy of investing a portion of his business profits into Bitcoin. In a sense, this regular investing from your income is a form of unavoidable dollar cost averaging, and it does serve to smooth the ride, but the big difference is you don't have the lump sum option. As an experienced bookkeeper, I recommend saving and investing 40 to 50% of your income. There's some science behind this, I'll make a future video on this. And here's why you shouldn't reinvest all of your money back into your business, but be buying Bitcoin.
But today, we're in a very important period. For the next 10 years, this is the digital gold rush. You can create a business, you can create a family, you can create a life, you can create compelling products. This is going to change everything, right? Everything, the insurance business, the banking business, the mobile apps business, the technology business. You know, if you're a dentist and you're clearing $500,000 a year, you're never going to be more than a dentist. You're not going to be Apple. But if you start sweeping your cash into Bitcoin and then lever it up, you may be a billionaire dentist. The most successful ETFs in the world, they were launched last year. They were the Bitcoin spot ETFs. In January of 2024, they launched. They've grown to be about 140 or 150 billion dollars in size. They're bigger than gold. They're the most successful ETFs launched in the history of Wall Street. My long-term forecast for Bitcoin is it's going up 30% a year for the next 20 years.
And
Frank,
is that literally your forecast?
That's what I said on stage in Nashville in July when Bitcoin was 65,000. I said it's going up 29% every year for 21 years. It'll be 13 million a coin as a base case in the year 2045. And what do I think? It's actually ahead of that pace. Right? And I mean, you can think of what's going on is a deceleration. It was growing at 60% a year. It's growing at 50% a year right now. It's going to decelerate from 50% down to 20%. When it's at 20%, the S&P will probably be growing 10 to 12%. This will just be better than that because you've stripped off the risk because it's pure digital energy. But from 60 to 20, by the time you work it out, maybe we're 50 right now, it gets to be about 29% on average over the next 20 years. So that's the easy number to remember.
Now remember, he's saying he wants to take big swings in his 20s, but here's the contradiction. Lump sum is the big swing. Dollar cost averaging is a cautious move. He's still playing defense with his dollar cost averaging strategy when he says he wants to play offense. For Bitcoin specifically, especially now, lump sum actually lines up better with his thesis. Bitcoin adoption has historically played out in cycles, with halvings followed by explosive bull runs. If his horizon is 20 or 30 years, short-term volatility doesn't matter nearly as much. What matters is being fully exposed when those cycles hit.
Now, third prediction is this. When will we peak? Well, in 2015, 2017, we peaked 518 days after the halving. And in 2019 to 2021, we peaked 546 days after the halving. So taking an average of these, it'll take us somewhere to August to October kind of time frame, 2025. But we have the ability now to create an offset to Bitcoin price. So this is no offset. The yellow line goes up, and then there's a lag. When you use that offset, the correlation is extremely high. Over the next 6 months, it'll be 88.1%. Over the next year, 91.4%. This is, in the finance world, extremely high correlation.
History shows us that lump sum investing outperforms DCA about 2/3 of the time. Why? Because markets go up more often than they go down. From 1970 to 2013, the market finished positive in 33 out of 43 years. That's about 70% of the time. So if you're stretching out your buy orders hoping for a drop, statistically you're betting on the less likely outcome. And second, market timing. A lot of people don't realize this, but by choosing to DCA, you're basically saying, I think the market's too high right now. That's just another form of timing the market. And timing the market is a game very few people win. And third, cash drag. When you DCA, a big portion of your money just sits in cash while you wait to deploy it. That changes your asset allocation whether you like it or not. If your plan was to be fully invested in stocks, suddenly you're not. You're over-speculating on cash and under-speculating on equities, which can hold back your growth. And finally, the risk never actually disappears. Even if you slowly average in over 6 months or a year, the day after you're fully invested, the market can still plunge. So in the end, you haven't avoided the danger, you just delayed it. That's why, historically, lump sum is usually the better move. So let's bring this back to BizPath. He's 27 years old, he's worth just under $1.1 million, and he's still in the wealth accumulation phase. This means his investing time horizon is decades long. When you've got more than 5 to 10 years ahead of you, the math overwhelmingly favors getting your money into the market sooner rather than later. The earlier it's working for you, the more time it has to compound. Here's the bottom line. Dollar cost averaging is the safer, more comfortable option. It smooths out the ride and protects you from the fear of buying right before a drop. But historically, it also leaves money on the table. Lump sum investing, while scarier up front, has proven to be the better bet most of the time because markets tend to go up more often than they go down. For someone like BizPath, he's young, he has a long time horizon, he's saying he wants to take big swings. Lump sum lines up with his goals far more than dollar cost averaging does. If he truly wants to capture asymmetric upside from Bitcoin, he's better off planting that flag today rather than dripping in slowly. That said, there's no shame in using DCA if that's what helps you stay invested without panicking. Here's the big takeaway. Dollar cost averaging doesn't win because of math. It wins because of behavior. It smooths out the ride emotionally, but not financially. So the real benefit isn't higher returns, it's simply helping you stay invested long enough to actually get those returns. So now I want to hear from you. If you suddenly had $250,000 to invest, would you dollar cost average it over time, or would you drop it in as a lump sum and let it ride? Drop your answers down below in the comments. I'm really curious how you think about risk versus reward here. And if you found this breakdown helpful, make sure to hit that like button, subscribe, ring the bell so you don't miss the next video. Thank you for watching, and I'll see you in the next one.